There's a specific kind of silence that happens right before a storm breaks. It isn't peaceful, it is heavy. It carries weight. If you talk to people right now, not the economists on television, but your neighbors, your colleagues, the people standing in line at the grocery store, you get the sense that we are living in that heavy silence. The headline numbers often look fine. Unemployment is historically decent, and the stock market has shown incredible resilience. Yet the sentiment is different. There is a pervasive, low-level anxiety that the ground beneath us isn't quite as solid as it used to be. We are going to talk about that feeling today. We are going to explore why the next economic downturn, whenever it arrives, might feel fundamentally different and perhaps harder than the recessions we have grown accustomed to over the last 30 or 40 years. We are not talking about a collapse of civilization or some hyperbolic doomsday scenario. We are talking about the mechanics of how an economy absorbs pain. For decades, we've had a very specific set of shock absorbers on the American economic vehicle. Every time we hit a pothole, in 2001, in 2008, even in 2020, those shock absorbers compressed, dampened the blow, and bounced us back to the smooth pavement. But if you look at the data from the Federal Reserve, the Bureau of Labor Statistics, and the Congressional Budget Office, you begin to see a picture that suggests those shock absorbers are worn out. They are already fully compressed. And when you hit a bump with compressed shocks, you don't float over it. You feel the impact in your teeth. Just a quick note before we dive in. This is for education and entertainment, not individual financial advice. I am looking at the system level, the mechanics of the machine, so you can make your own informed decisions. To understand why the future might feel harder, we have to understand why the immediate past felt, in a strange way, easy. Since the early 1980s, the United States economy has operated with a massive structural tailwind, the long-term decline of interest rates. In 1981, the yield on the 10-year Treasury was over 15%. From that peak, for 4 decades, it trended down, eventually hitting near zero in 2020. This wasn't just a line on a chart. This was the gravitational force of the financial world getting weaker. When interest rates fall, assets rise. It becomes cheaper to buy a house, so home prices go up. It becomes cheaper for corporations to borrow money to buy back their own stock, so share prices go up. It becomes cheaper for the government to service its debt, so we can spend more without immediately feeling the pinch. This environment created a distinct psychological training ground for investors and consumers. We learned that every time the economy wobbled, the Federal Reserve could simply lower rates, print money, and inject liquidity. We learned to buy the dip because the dip was always shallow and the recovery was always V-shaped. This was the Fed put, the idea that the central bank would always be there to cushion the fall. But that era relied on one critical condition: low inflation. As long as inflation was dormant, the Fed had a free hand to print money and cut rates. That condition has changed, and this is the first reason why the next downturn may feel harder: the loss of the monetary safety net. We are entering a period where the Federal Reserve is constrained. If the economy slows down but inflation remains sticky, staying above that 2 or 3% target, the Fed cannot aggressively cut rates without risking a resurgence of price spirals. We saw a glimpse of this in the 1970s, but most people investing today weren't managing money then. The sensation of a central bank that cannot help you is foreign to the modern American psyche. Imagine a recession where the stock market falls, unemployment ticks up, but mortgage rates don't plummet to 3% to save the housing market. Imagine a scenario where the government wants to pass a massive stimulus package, but the bond market revolts because the national debt is already so high that the interest payments are consuming a massive chunk of the federal budget. This is what it means to drive without shock absorbers. The volatility isn't dampened, it is transferred directly to you, the household. This brings us to the second structural shift, which is perhaps the most personal: the saturation of debt. According to data from the New York Fed, household debt balances have continued to rise, but the composition of that debt is worrying when paired with higher interest rates. For a long time, we treated debt as a tool for wealth creation, leverage to buy appreciating assets.
But as rates reset, debt transforms from a ladder into an anchor. The harder feeling of the next downturn will likely manifest in the lock-in effect. Consider the housing market. We have millions of Americans sitting on mortgages with interest rates under 4%. This sounds like a good thing, and individually it is, but systemically it creates a rigid housing market. People cannot afford to move. They are trapped in their golden handcuffs. If you lose your job in a typical recession, you might sell your house and move to a cheaper area or a region with better employment prospects. In this new environment, selling your house means trading a 3% mortgage for a 7% mortgage. The monthly payment on a similar or even smaller home would double. So labor mobility freezes. People stay stuck in cities where there are no jobs because they cannot afford the cost of capital required to move. This rigidity makes the economy less dynamic, meaning the recovery from a downturn takes longer. It's a slow grind rather than a quick snapback. We also have to talk about the demographics. This is the silent engine that drives almost everything in the long run. Data from the Social Security Administration and the Census Bureau paints a very clear picture. The baby boomers are retiring. This isn't news, but the economic impact is hitting its stride right now. For the last 40 years, we had a massive surge of workers entering the labor force. When you have lots of workers and not as many retirees, you have high production and relatively suppressed wages. That's deflationary. It helps keep prices low. Now that flow is reversing. We have a shrinking ratio of workers to retirees. When labor is scarce, workers have more bargaining power, which drives up wages. While higher wages sound great, and they are for the recipient, in a macro sense, without a matching increase in productivity, they fuel inflation. This puts us in a bind. We have a structural labor shortage that keeps inflation simmering, which in turn forces the Federal Reserve to keep interest rates higher than we are used to.
This demographic shift also impacts the stock market. For decades, boomers were in the accumulation phase, blindly buying stocks in their 401ks every 2 weeks. That is a relentless bid under the market. Now, they are shifting to the distribution phase. They are selling stocks to pay for living expenses and healthcare. Who is buying? The Millennial and Gen Z generations are smaller in terms of capital concentration. If you have more natural sellers than natural buyers, the valuation multiples of the stock market, the price you pay for $1 of earnings, tend to compress. This creates a scenario where the market could go sideways for a long time. This is the harder part for the average investor. We are addicted to the idea that the S&P 500 does 10% a year like clockwork. But look at the period from 2000 to 2013. The market was effectively flat for 13 years. Adjusted for inflation, you lost money. If we enter a similar period of stagnation caused by high valuations meeting demographic headwinds, it will be psychologically devastating for a generation of investors who view the stock market as a high-yield savings account. The hard part won't be a crash, it will be the boredom. It will be the slow realization that your retirement date is drifting further away, not because you lost everything, but because your portfolio just isn't growing faster than the cost of living. Let's look deeper into the government's balance sheet because this ultimately trickles down to your tax bill and your currency. The Congressional Budget Office projects that interest payments on the national debt will soon exceed the entire defense budget. We are entering a phase called fiscal dominance. This is when the government's debt is so large that the central bank loses the ability to control inflation solely through interest rates. If the Fed raises rates to fight inflation, the government's interest bill explodes, forcing the government to print more money to pay the interest, which causes more inflation. It is a feedback loop. Historically, when nations get into this position, they choose one of two paths: austerity, which means cutting spending and raising taxes, or financial repression. Austerity is politically unpopular. No politician gets re-elected by promising to cut Social Security and raise income taxes. So the path of least resistance is usually financial repression. This is a technical term for a simple concept, allowing inflation to run slightly higher than interest rates for a long time. If inflation is 4% and the government bonds in your portfolio are paying 3%, The real value of the government's debt is shrinking by 1% a year. The government is essentially inflating away its debt at the expense of savers. This is why the next downturn feels harder. It might not feel like a sharp recession where you lose your job. It might feel like a decade where you keep your job, you get a 2% raise every year, but the cost of meat, insurance, and energy goes up by 5%. You are working harder, running faster, but slowly falling behind. It is a quiet, suffocating erosion of the middle class rather than a dramatic explosion. This erosion is exacerbated by the wealth effect working in reverse. For years, American consumption has been powered by rising asset prices. You feel rich because your house is worth more, so you spend money. You feel rich because your 401k is up, so you buy the new car. If asset prices stagnate or slowly decline in real terms, that psychological wealth evaporates. Consumers pull back. And since consumption is 70% of U.S. GDP, the economy slows down. We also have to address the fragility of the corporate sector. During the zero-interest rate era, many companies survived not because they were profitable or efficient, but because money was free. These are often called zombie companies, firms that don't earn enough profit to cover their interest payments, but kept rolling over their debt because rates were low. As rates stay higher for longer, these companies face a wall of maturities. They have to refinance their cheap debt at expensive rates. Many won't be able to. We may see a slow-motion purge of inefficient businesses. While this is healthy for the capitalist system in the long run, the process of clearing them out involves layoffs, bankruptcies, and market volatility. It is the painful withdrawal symptoms after a decade-long sugar high. So we have a convergence of factors: a constrained Federal Reserve, a demographic cliff, a debt-saturated government, and a reversal of the asset price tailwind. This sounds bleak. It sounds like I'm telling you to build a bunker. I am not. In fact, understanding this reality is the most empowering thing you can do. The harder downturn creates opportunities, but only for those who recognize the new rules of the game. The old rule was leverage is good. The new rule is liquidity is king. In a world of higher rates and stickier inflation, the person with no debt and cash on hand has the optionality. When the shock absorbers are gone, the ride gets bumpy. The passengers who are strapped in with high savings rates and diversified assets will be fine. The passengers hanging off the side of the car, leveraged to the hilt, hoping for a smooth road, are the ones in danger. This brings us to the behavioral aspect of finance. Why does this future feel so daunting? It is because of the hedonic treadmill and loss aversion. We adapt very quickly to good conditions. We have adapted to the idea that a mortgage should cost 3% and the market should return 15%. Resetting that baseline expectation is painful. It feels like a loss. And in behavioral psychology, we know that the pain of a loss is twice as powerful as the pleasure of a gain. But let's look at the data again. Even during the stagflation of the 1970s or the sideways markets of the 2000s, people who consistently bought the market, who lived below their means, and who reinvested dividends came out ahead. The math of compounding still works. It just requires more patience now. The get-rich-quick energy of the 2020 to 2021 era is gone. We are returning to the historical norm where wealth is built slowly, boringly, and incrementally. The danger of the next downturn isn't the economy itself, it's your reaction to it. If you expect a quick Fed rescue and it doesn't come, you might panic and sell at the bottom. If you expect inflation to vanish instantly and it doesn't, you might make poor spending decisions. The harder nature of this environment tests your temperament more than your intellect.
We must also consider the geopolitical layer, which acts as a massive variable in this equation. For 30 years, we exported our inflation to China. We used cheap labor and efficient global supply chains to keep the cost of goods down. That trend of globalization is fracturing. We are moving toward onshoring and friendshoring. We are building chip factories in Arizona instead of relying solely on Taiwan. We are securing energy independence. While this makes our supply chains more robust and secure, which is a good thing, it is also more expensive. Building things in America with American labor and environmental regulations costs more. This is another inflationary pressure that prevents the Fed from returning to the easy money days. It confirms the thesis that the buffer zone of cheap goods is gone. So, how do we navigate a world with no shock absorbers? We build our own. Since the system is more brittle, your personal finances must be more robust. First, this validates the boring, unsexy strategy of the emergency fund. In a high-interest rate world, cash isn't trash. It actually pays a yield. Having 6 to 12 months of expenses in a high-yield savings account or money market fund isn't just about safety, it's about not being forced to sell your assets at the wrong time. If you lose your job in a hard recession where liquidity is dry, having cash means you don't have to sell your stocks when they're down 30%. It buys you time. Second, it reinforces the importance of broad diversification. For a decade, you could just own the S&P 500, specifically big tech, and win. In a regime of higher inflation and commodity scarcity, other asset classes might take the lead. Value stocks, international equities, energy, and perhaps even managed futures or trend-following strategies become more relevant. The 60-40 portfolio of stocks and bonds took a beating recently because stocks and bonds fell together. But over the long term, owning a slice of the entire global economy is still the most rational bet against uncertainty. Third, we have to look at the liability side of your balance sheet. Aggressively paying down high-interest debt is a guaranteed, tax-free return equal to the interest rate. If you have credit card debt at 20%, paying that off is better than any investment you will find in the market. In a hard economic environment, lowering your monthly burn rate is more effective than trying to increase your income, because you have total control over your spending and only partial control over your income. There is a silver lining to all of this. A harder economy is an honest economy. The zero interest rate period distorted reality. It allowed money-losing companies to pretend they were successful. It encouraged rampant speculation in JPEGs and meme coins. It widened the wealth gap by inflating assets that the wealthy owned, while wages for the working class stagnated. A period of higher rates, while painful in the transition, eventually restores a hurdle rate for capital. It demands that money be treated with respect. It rewards saving. It rewards actual profitability. The transition to this honest economy is what we are feeling right now. It is the withdrawal from the addiction to cheap credit. It hurts. It feels heavy. It creates that silence in the grocery store line where everyone knows the dollar doesn't go as far as it used to. The typical recession of the recent past was a pause button. We hit pause, fixed a few things, printed some money, and hit play again. The next downturn is likely a reset button. It changes the operating system. We are moving from a world of abundance of capital and scarcity of labor to a world where capital has a cost and labor has value. If you are a passive investor, someone who believes in the long-term ingenuity of the human spirit and the American economy, you do not need to be afraid of this. You just need to adjust your expectations. The line on the chart might be jagged for a while. The wealth effect might not make you feel like a genius every time you open your brokerage app, but the fundamental engine of capitalism, companies solving problems to make a profit, doesn't stop just because interest rates are 5% instead of 0. In fact, the companies that survive this harder environment will be stronger. They will be lean, efficient cash flow machines. And if you own the total market index, you will own the survivors. You will capture the value they create. The narrative of doom sells newspapers and gets clicks, but the narrative of resilience is what builds lives. The next downturn may feel harder because the training wheels are off. The government can't save everyone, and the Fed can't print prosperity. But this places the agency back in your hands. It means your savings rate matters. Your debt levels matter. Your patience matters. We are walking into a stiffer wind, that is undeniable. But a stiff wind is only a problem if you're built of straw. If you build your financial house with brick, diversification, liquidity, patience, and a rejection of consumer debt, the wind is just weather, and weather always passes. The uneasiness you feel is real. It is the sound of the tectonic plates of the global economy shifting. But remember, shifts create new landscapes. The next 10 years won't look like the last 10, but for the disciplined investor, they can still be years of profound growth. It just won't be given to us. It will have to be earned. And perhaps, in the end, wealth that is truly earned feels better anyway.